Many people think you have to become a stock picking genius to make money in the stock market. No. ETFs is one of the most simplest way you can actually make so much money in the stock market without becoming a stock market analyst or a researcher. My name is Providence. Welcome to Clockwise. Today we're talking about 5 ETFs that can make you a lot of money even without having a vast knowledge about the financial market. Now, I won't be doing this alone as usual. My guest is here. The one that sleeps on the charts and also sleeps on the fundamental of these businesses. He works with Francisco Alpha. Now, with a resounding virtual round of applause, welcome, Mr. Gardner. Welcome to Clockwise.
Thank you very much for having me.
It's nice having you again,
Yes.
often every time. Now, let's go straight to business. For someone who have never done ETFs before, who have never picked ETF before, why do you think a person should choose an ETF instead of just picking 3 to 5 stocks? Why?
Because you need to do a lot of research
Okay.
to ensure that the stocks that you are picking, those 3 to 5 stocks, are winners.
Okay.
So if imagine if you're a brand new person to the market, then that means, you don't have any information. You don't know how to do research. You don't know how to do technical analysis. You don't know how to do anything whatsoever. Then you are going to be literally caught napping.
Yeah.
So a way of simplifying everything is to have a basket of equities that you invest in, and so you have broad exposure to all of those equities.
You see, in the Nigerian economy now, for instance, we are having, let me not say inflation is actually coming down. Inflation is looking like it's coming down. We are having high interest rates and the rest of it. Do you think investing in ETFs, actually growth ETF, is the best decision currently?
If you want exposure to the equity market, then of course investing in the growth ETF, because the way it works is it actually has a basket of equities. So when you invest, you are literally getting exposure to the general, or what we call the average growth of all those names. For example, some of the ETFs that we have, especially the growth ETFs, are ETFs that focus strictly on equities, growth prone equities. Okay. Some of the top performers on the NGX. So obviously, like I said, you cannot you will be marginally comfortable. You would have the gap between what your returns and inflation will be extremely marginal. But if you want to really outperform inflation, then you are looking at ETFs. You are looking at equity markets, ETFs that track the equity market. So that is exactly what you should be looking at. If you look at, let me give you an example. Okay. If you look at the NGX, for example, the NGX is down 5%. Okay. In the index. Sorry, not the NGX. No, the insurance index. I'm sorry to say that. The insurance index is down 5%. Yeah. But guess what? When we did our review in the last live, you saw that there was a particular insurance name that was already up more than 100%, year to date. So what that tells you is that the growth. Imagine if you pick, while there was a name that was literally down more than 30, almost 40%. Year to date. So what does that tell? It tells you that there are some names that might not perform, might be laggards. Okay. Imagine if you pick those laggards. Okay. What do you think will happen? So if you went for the ETF, then there's a high chance maybe the ETF will have returned minus 5%, but it's better than being sitting on minus 40%.
Now, we realize that one of the mistakes investors make in the stock market or in the financial market is timing the market.
Yes.
Because of that, most of them usually buy at the top and they will sell at the bottom. So what are those mistakes you think people make investing in ETFs?
No, so the point is, number one, you don't look at the net asset value. A lot of people just invest in an ETF. So there are some things you have to look at. Okay. You look at the spread. Now you look at the net, as what we mean by net asset value is that, like I said, ETF is a basket of equities. Yeah. So what is the total asset value of the equities that are in this basket? Okay. Then you look at the price. What is the spread? What is the difference between the net asset value and the price of the ETF? Sometimes it suffers a very huge dislocation. Sometimes you have a yawning gap between the net asset value. And so what that means is that if, let's say, the gap is like sometimes up to 10%, that means that is the difference. Sometimes you might have growth in the net asset value, so the underlying asset might grow 10%, your ETF will still be down, or might grow 10%, your ETF will be way higher. So that swing, you want to look at the disparity between the net asset value and the price of the ETF, and then also look at the some fees also. How much are you charged by being part of that? Because the reality is that most of these exchange traded funds, there are some fees attached. So you want to be sure that because let me tell you something, a lot of investors don't know, but fees can eat so much into what your returns. Your absolute returns is whatever you have made minus the fee. So you want to look at it that too. Then the other thing is that you want to be sure that the fund that you're tracking is as diversified as possible in terms of, if it's a growth ETF, is it focused on names across board? So industrials, we have growth stocks in industrials, we have growth stocks in the banking, we have growth stocks in the in the consumer goods. So you want to ensure that even growth stocks in telecoms, oil and gas, so you want to ensure that it is broadened out across all of this area, not just focused in the. There are some ETFs that are focused on a particular sector. For example, like VetBank, the Vetiva banking ETF. And we understand that that is just focused on the banks. But if it's a growth ETF, for example, then it has to pick across board so that one sector coming down does not spell doom on the other sectors.
Now, before I actually ask this question, it will be as if this is my final question. If you have a million naira, how will you allocate or allot the million naira into a certain ETF? Before then, I knew you came with a list of 5 ETFs that are very, very, should I say, they are doing very well now. They have potential upsides. I would like to hear those lists. What are those 5 ETFs?
The first ETF I'm going to talk about is an ETF that someone mentioned on the group and then talked about. Someone was trying to find out.
Before then, we have a group, a community, a Telegram community, and if you want to participate or you want to be having real-time information about whatever we are speaking or we are saying here, if you go to our profile page now, you see a link that leads you directly to our Telegram community. So we have a lot of conversation going on there, and most times we bring the conversation to this particular platform. So let's hear it.
So the first one, someone talked about trying to get exposure in one of the sessions we had when we talked about compound interest, and we showed how investing in the S&P 500 for about maybe 10 years at a traditional return of 11%, how it could really, really multiply people's wealth because of effects of compound interest. So she asked the question if she wanted to invest in I used the S&P 500. So he said, do we have an equivalent in Nigeria? Of course we don't, unfortunately. But what we have something that
looks like.
So because in the NGX, of course, it's the all-share index is actually market cap weighted. So we have something that is close to that, which is the NGX 30. That is the top 30 companies on the NGX. So we have an ETF that actually follows that, which is the Vetiva Griffin 30. ETF. So that actually tracks the top 30 companies. If you look at this, you realize that some of the biggest growth that you have are actually concentrated in these names. Yes, because like I told you, the way it works is when a name becomes large, then you have that some analysts begin to focus on those names, especially public listed companies. So analysts focus on those names. Let me tell you, foreign portfolio investors, even domestic investors, try to look at where the foreign portfolio investors are actually looking at, because there's this belief that they know what we don't know. But the reality is that the foreign portfolio investors don't actually know so much. They actually rely on what local analysts are saying about companies. So a company comes in, it gets into within the limelight of a foreign portfolio or analysts. Analysts begin to talk about it, and then foreign portfolio investors and institutional investors, foreign pension fund managers and sovereign wealth funds begin to look at those names and then invest in those names. So we've seen traditionally, like we have 30 companies, the top 30 companies on the NGX seem to have this position, this advantage. That's why I told even some of the platforms that you can take a loan, like margin loan against your holdings, they restrict it to the NGX 30. So the ETF that follows this is a Vetiver Griffin ETF 30. So now it allows you to gain broad exposure. I mean, you have names like MTN, you have Dangote Cement, you have GT
just the top 30.
The top 30.
Top biggest.
The top 30 companies, equities. So that allows you to have exposure. And if you look at it, you realize that even though it is not representative, I'm going to say this, we have over 130 companies listed on the floor of the Nigerian Stock Exchange. Now, and this
represents
and this is just 30.
Yeah.
But because it is market cap weighted, you see that the market leans so much. Whatever happens within this top 30 literally influences the outcome that you have. That's why, and these are the guys that actually lead recovery rallies, if you look at it. Because when investors are rotating back into equities, guess what they look at? They don't want to go down the risk curve. Yeah. They just focus on top of this stock names. Yeah. This stock name. So you might want to look at Vetiver Griffin 30 because, especially if you don't want to pick and choose. And by the way, experience have shown that people who try to pick and choose, especially if you're a beginner, before you can say you can pick and choose, there are some things you have to do, and there are no substitute to this. Some people try to replace that with just listening to what someone said on TikTok, and then you think you can make it. No. Even on Clockwise, even when we research, we do thorough research, but we still tell you to do what? Do your own research, to speak to a licensed investment analyst or stock broker. So that's because we don't want you to pick and choose as a beginner, because there's a very high chance that you're going to pick the wrong thing. So you can pick Vetiver Griffin ETF, and it's actually, there are so many names that you could be looking at investing all at the same time, because when you invest, you are literally investing in a basket that contains the top 30 names on the.
All right.
The next one is Meristem Growth. It's been on a downward spiral for a very long time, but I can see that it's beginning to gain some legs. For me, I think it's beginning to get some legs, responding. These are growth ETFs. One of the things about growth, you remember that some of these have a higher beta than the market. What I mean by that is that if the market falls 20%, they could fall 40% if they have a beta of 2 and all that. So, but when the market recovers, they can recover insanely, So Mary Growth ETF, if you look at the charts, in fact, if you attempt to look backwards, you would say it was a scandalous fall. But it's one of the growth ETFs that you could be looking at, because this ETF actually has it brings together the growth names, the GT codes, the Zenith Bank, the GT code story, the FBN Holdings, some of those growth names, and all that. So they bring together, and then when it's on steroids. That's why I said it's on steroids. If it corrects, it can correct very sharply. It can correct very sharply. It's the aggressive version, the aggressive ETF. So it can correct very sharply. Really, you can see a very serious red candle on the day. You can see a very serious green candle on the day. 10% down in a session is very, very common. Okay. So if you want the adrenaline, you can go to Mer Growth ETF or Meristem Growth ETF. The ticker symbol is Mer Growth. So you can go for that. But if you
huge downside, huge upside.
Very huge on steroids, actually. Yeah. But if you want to get,
if you can take the risks,
you can take the risk. That's what I'm saying.
It can go very bad. It can go very.
So it can go very. Like I told you, having 10% up, 10% down is not uncommon for that particular ETF.
So if you have the allowance to,
if you have the capacity to contain that price swings, then you can actually go for that ETF. Otherwise, I would like you to stick to this Vertical Growth ETF that we have mentioned here. And but like I said something, you also want to, for most of these ETF, you want to monitor what I can call their net asset value, because that can actually they can be that spread is usually something that could be quite kind of worrying. Now the other one is, I mean, we've talked about growth, we've talked about the top 30. Then I also want to talk about an industry that has been moving very, very quickly, very, very fast. If you want to invest, if you tell someone coming to invest in the stock market, guess which sector they will go for first? Banks. There's an ETF that tracks banks. Yeah, there's an ETF that tracks banks. The Vertical Bank ETF. Okay. So if you don't want to pick and choose a name, for example, we saw FBN do over 120 or 131% in just 1 month. Yeah. Now, if you are not in First Bank, you will feel very terrible. But if you're in an ETF that tracks banks, that growth will be reflected in the ETF. Yeah. That's the advantage of ETF. ETF is, if you were sitting on GTCO, for example, all through the run-up of First Bank, GTCO did not budge. The Bank did a little bit. There was no, GTCO did not budge at all. So if you had packed, imagine if you had packed so much of your money on just GTCO, then you would have actually been, quite sad. And that is why we also say that please do not, even no matter how good a name is, I can't say this, can't oversay this, no matter how good a name is, do not just pack all your investment into a name. Yeah. There's something called position sizing. You have to size up your position to ensure that you are not too allocated to one sector. Even in the banking ETF, and that's why we're talking about banking ETFs now. Even in the banking ETFs, banking, you don't want to. Some people will tell, I know someone that called me and said, I want to invest in GTCO. That's all. I told him, well, why don't you? I was trying to set up his portfolio for him. I said, okay, why don't we do? He said, no. Apparently, someone had told him and convinced him that GTCO is the best thing since sliced bread. So he was giving me a directive, he was not asking me to guide him. He was giving me a directive. So you can imagine how he felt when he saw FBN and First Bank run up, and then GTCO did not budge at all. I mean, so that's why we try to diversify. GTCO was the darling earlier this year. Zenith Bank was the darling earlier this year. But I mean, over the past 2 months,
ETF makes you benefit from.
ETF makes you to benefit from all of it. Whichever wins, you actually get from. So, Vertical Bank ETF is an ETF you could actually be looking, looking at. Putting on your watch list, possibly allocating to. Because when the banks recover, a lot of the banks like GTCO has even gotten approval to delay its half-year results to ending of September. So that means over the next over a month from now, we are not expecting any release from GTCO. Which is also, by the way, that is even the end of the third quarter. You are now releasing the half-year result at the end of the third quarter. It is what it is. So another name that has been very, very successful has been the industrials. Okay. Industrials have made so much. Yeah. If you look at industrials, they have some of the behemoths. You can see some very, very good. If you look at the likes of HBM, look at the likes of Dangote, look at the likes of Boa has given by a lot of the gains. But I'm talking about like the HBM and Dangote. Those guys have actually printed a lot of money. Now, you imagine if you're on Boa. I told you of someone that I know of. She literally put almost all of our investment in Boa Cement. Now, she's obviously very sad at this point. There are very few people on the planet that are as sad as her. No, so now, but imagine if she had gone for an industrial ETF, for instance, that would have given her we've seen the kind of insane run that HBM has done. We've seen the kind of insane run that Dangote Cement has done.
Yeah.
So imagine if she had allocated across board. I mean, invested in an ETF that tracks the entire industrial space. She would have been up a decent amount year to date. So there's a Vetiva industrial ETF that allows allows people to actually gain exposure to the industrial sector, because the reality is, like we have already identified, industrials would have a lot of growth potentials ahead of it. I mean, you can see everybody's talking about real estate, developing real estate, roads are now being paved with cement and all of that. So
population is actually
population is increasing, and as far as there are more humans, there will be more places for people to live, and then you are going to have a lot of those names perform. So instead of having to pick and choose, instead of having to be sad that you're in Boa Cement and not on HBM, then why don't you focus on just buying the ETF that tracks all of them?
So the last one?
So the last one is, of course, consumer goods. We can't talk about ETFs without mentioning consumer goods.
The ETF that tracks industrial is what?
The Vetiva ETF. Then you have also consumer goods, vet goods. So that actually tracks the consumer goods. I mean, if you think about the fact that if you had invested in a name like Boa Foods, you would have made a ton of money. But if you had invested in a name like maybe Nestle, it's been
Dangote Sugar.
Dangote Sugar has been giving up a lot of its gains because of the public offer they had to raise money. But I mean, I know that Dangote Sugar is going to go back. I see this dislocation as a buying opportunity, actually, because Dangote Sugar, I believe, is going to go back up. But why do you have to pick and choose? Why do you have to pick and choose? Why do you have to sit down and see some other sectors rally? Because the reality is that even within a particular sector, you have names that see the light of the day at different times. This particular name would have its time in the sun, maybe this month. Next month you have. So there's that rotation. What professional investors do and portfolio managers do is that if the name runs up, we don't chase price. Yeah. So if the name runs up, if there are two names, same fundamentals, everything the same, and this particular name runs up, investors do not try to chase, professional investors or professional do not try to chase this name, because sometimes it might be run up and become very expensive. So what we do is we look at the name. That's why we talk about the PE ratio, which allows you to compare within industries. If this name has run up, except in very isolated cases, I'll give you an example. Like FBN has run up. Yeah. You have not seen that trickle down effect into other names. Okay. Do you know why you have not seen that? Because there's a single narrative that actually led the runoff. Number one, FBN actually brought out very sterling results, but most importantly has been the very bullish, aggressive accumulation by the chairman of the company. Okay. So that is more like an isolated case, not the only case that is a bit broad that would have trickled into other names would be the results. FBN did a very impressive result. Impairment charge was kept at bay, and then the growth was also good there. Okay. So we look at if it's good for the goose, it's also good for the gander. If it's good for FBN, then there are chances that other names will make a very good impression. So why don't you, instead of having to make this choice, you can just invest in the ETF.
All right. Before you answer the last question, which will be you to allocate 1 million naira to each of these ETF you mentioned today. Before you answer that question, now I would like you to go through that list again and pinpoint those ETFs again. Let's get it. Let our viewers get it very clear.
So the first one we talked about, Growth ETF, Merry Growth. Okay. We talked about we now moved into the NGX 30, and then we talked about the banking ETF.
That's Vetiva.
That is banking, Vet Bank.
Okay.
Then we then moved into the industrials,
which is Vets
Industrial.
Okay.
Then we now moved into the consumer goods.
All right, now allocate 1 million naira to each of them.
Like more than 30% of my will go to VET 30. More than 40% actually.
VET 30
will go to the top 30 ETFs.
Okay.
NGX 30.
Okay.
And the reason for that is this. Because if you look at, I mean, these are the behemoths. So you always want to, these are the guys that will not,
that move the market.
That move the market, and you will not have a lot of drawdown.
The big money goes to that.
So VET Growth 30 will take about 30% of, 40% of my, I have
VET Growth or NGX 30?
No, VET Growth 30 tracks the NGX 30.
Okay, yeah.
So then the rest 40 would be shared to the 4 ETFs. The rest 60 will be shared to the rest 40. The reason is because the behemoth.
You have to go where the money is going.
I have to go where the money is going.
You cannot go against the money. The money cannot be going here. You go this way.
I go this way because I remember growth. I am very, very passionate about growth.
Yeah.
Okay. So the remaining 60. Let me do it this way. May growth is actually turning. I think I see it turning. That has a very serious down draft. Very, very serious one. But I'm saying it looks like it's turning the corner.
Okay.
Yeah. So I would do about 20% there. Why am I doing that? Because
technical analysis of it.
Yeah, we should. We should
do by Wednesday.
Maybe we should.
Yeah.
Okay. So I want to gain exposure to that recovery story.
Okay.
Now, I will do that. So 60% is already gone. I have just about 40%. I'll do 15%, obviously, to the banks.
Okay.
Because
the banks are still part
the
of
banks.
The
No, I know,
yeah.
I know, but I want very good exposure to the banks.
Yes.
I'll do another 15% to the industrials. You have the behemoth there. Then I'll do 10% to the consumer goods.
All right. Okay. Now, by Wednesday, we should actually have a live analysis, technical analysis of these ETFs by Wednesday. Please keep a date with us. Thank you very much for coming.
You're welcome.
That's very great. All right. On that note, we'll come to the end of today's episode of Clockwise. Please do not forget to like, subscribe, share, and also put on the notification bell on this channel because of the amazing content we bring. And also, if you want to join our community, we have a Telegram link on our profile page. If you go to our profile page now, you see a Telegram link that leads you straight to our community where we have real-time conversation and we provide answers real-time to everybody that's interested in the Nigerian stock exchange and other market. My name is Providence. There is always a bull market every time, and we are here to help you find it. See you again.